Hello, good day. This is Dr. Don Charles. Welcome to this lecture in my course, Day Trading Stocks. This lecture will cover technical analysis. So the outline of this lecture includes technical analysis of stock prices, candlesticks, candlestick patterns, moving averages, Bollinger Bands, and the relative strength index. Note, in this course, I use multiple tools to trade. I use websites, I use the news, and I use technical analysis tools. When traders go on a market to trade, they do not have a crystal ball. No trader, no investor has a crystal ball that tells them exactly how the price of different stocks and other assets will move. Successful traders are the ones that use a series of tools and they manage to use the tools properly and effectively to trade. As a trader, you need to know how to use your tools. You have to know how to use them properly. If you do not use your tools properly, they may not work for you. Nothing is wrong with the tools. You are just not using them properly. In this course, I teach you how to use the tools. So in a previous video, I looked at fundamental analysis. Do you recall what is fundamental analysis? That is where we look at different economic factors, industry factors, and the financial factors related to a firm to decide if to buy or sell stocks. In technical analysis, we consider indicators and we use these indicators to tell us if to take a trade. There's a subset of technical analysis called price action analysis. Price action analysis relies on charts and chart patterns to inform decision making in trading. So the first tool we consider in technical analysis is a candlestick. A candlestick shows the behavior of price over a period of time. Assume the time period you are considering is daily. Then each candle will show you how the price is behaving each day. So candlesticks have different parts. They have bodies and they have wicks. This is a body, this is a body. This is a wick, this is a wick, this is a wick, this is a wick. So in a green candlestick, it suggests that the price of the asset is increasing. So this is the open price, this is the closing price. The price of the stock closed at a higher price than what it opened at. So this is a green candlestick right here. This is a green candlestick right here. In a red candlestick, it suggests the price of the asset is going down. This was the open price. This was the closing price. The price of the stock closed at a lower price than what it opened at. This is the red candlestick. This suggests prices are going down. This area here between the open and the close is the body. This area here between the open and close is the body. This is the highest point. This is the highest point. The area between the highest price and closing price in the green candlestick is a wick. The area between the highest price and open price in a red candlestick is also a wick. The area between the open price and lowest price in the green candlestick is a wick. This is a wick. The area between the closing price and lowest price in a red candlestick is a wick. Remember, green candlesticks suggest that the price of the asset, here the asset we are considering as stocks. So a green candlestick suggests that the price of the stocks is going up, whereas a red candlestick suggests that the price of the stocks is going down. Now, although we have red and green, sometimes we can have black and white. If we have black and white candlesticks, the white candlestick suggests that the price of the asset is going up. If it is we have black candlesticks, the black candlestick suggests that the price of the asset is going down. So in other words, what I'm trying to say is that if the candlesticks were colored black and white instead of green and red, the white candlestick would be analogous to the green candlestick, meaning that the price of the asset or the price of the stocks is going up, whereas the black candlestick will be analogous to the red candlestick, suggesting that the price of the stock will be going down. Now, there are many different kinds of candlesticks. This is one of the popular ones, the doji. Dojis have long wicks on both sides and small bodies. In other words, in a doji candlestick, the open price is very close to the closing price. So here we see a doji candlestick. This was the open price. This was the closing price. How we know this was the open price and this was the closing price? Well, this is the green candlestick. So it suggests that the price closed at a higher price than what it opened at. However, because this is a doji, the body is very small. The body is thin, almost like a line. The same principle applies to a red candlestick that is also a doji. This was the open price on top. This was the closing price. It's a very small body. Dojis tend to have long wicks. So this was the highest price. This was the closing price. This area here is a wick. This was the lowest price. This was the open price. This area here is a wick. The same principle applies. This is a wick. This is a wick. This type of candlestick is a doji. The next type of candlestick is a hammer. Hammer candlesticks have long wicks at the bottoms. So in a green candlestick, this was the open price, this was the closing price. The price of the asset closed, the price of the stock closed at a point very close to the highest price. In fact, sometimes the price may close at the highest price. This is a hammer. Hammers tend to have long wicks. So if we were looking at the daily time chart, what this meant is that during the day, the price of the stocks opened at this price and then went down to this price here. This was the lowest price. However, some point in time during the day, the price changed and the price went back up and the price closed at this point here, very close to the highest point. This is a hammer. This suggested at some point in time during the day that sellers were overpowering buyers. However, before the day ended, the market changed and buyers came back in on the market and buyers gained strength and buyers overpowered sellers. A similar principle can be applied with this candlestick here. So this was the open price, this was the closing price. The price closed at a lower area than the open price. This was the lowest price for the day. This was the closing price. This was the highest price. So the price of the asset, the price of the stock opened very close to the highest price. Then the price went down during the day and then went back up and it closed at this area here. This is a hammer. This suggests that at some point in time, sellers were overpowering buyers and the price reached the lowest area right down here. However, during some point in time in the day, just before the market closed, buyers came in on the market and gained some strength and were overpowering sellers to some extent. However, the price still closed at a lower point than the open price. This gave rise to this hammer. So these are other candlesticks. These are doji candlesticks. This is a dragonfly doji. This was the highest price. This was the open price and also the closing price. This was the lowest price. What happened here is the price of the stock opened right here at the highest price. Then the price of the stock went down. It reached the lowest price and then went back up and closed at this price here. The stock closed at the same level or at the same price that it opened at. So the open price and the closing price was the same. This was the lowest price. This was the highest price. This was also the open price. This was also the closing price. This type of doji is called a dragonfly doji. The opposite to the dragonfly doji is the gravestone doji. This was the highest price. This was the lowest price. This was the open price and this was the closing price. So the price opened here. It went up to the highest price during the day and then went back down and closed at this price right here. This gave rise to the gravestone doji. Then we have the long leg doji. This was the first type of doji we saw. This was the open price and this was the closing price. This was the highest price. This was the lowest price. This type of doji here signaled that there was some form of indecision in the market, in the sense that buyers came in and the market went up, sellers came in and the market went down. However, during the course of the day, buyers were not able to overpower the sellers and the price of the asset ended up closing at the same price at which it opened at. So these are other types of candlesticks. We have an inverted hammer candlestick. We have a Marubozu candlestick. The inverted hammer is the opposite to the hammer candlestick. So this was the open price. the open price was the lowest price, then the price of the asset went up to the highest price, and then it came down here and closed at this price here. So what happened is during the day, the price of the asset opened here, then as buyers came on the market, the price went up to this high point here, and then eventually sellers came in on the market and it caused the price to go down, and the price of the stock closed at this point right here. This gave rise to the inverted hammer candlestick. There was a long upper wick. Likewise, we have an inverted hammer candlestick right here. So the price of the stock opened here, it went up to this point here as buyers came in on the market. Eventually, sellers came in on the market and the sellers overpowered the buyers. So this caused the price of the assets to go down here and close at the lowest point right here. This gave rise to the inverted hammer candlestick. This is a Marubozu candlestick. In this green candlestick, this was the open price. The open price was the lowest price, and then the price of the stock closed at the highest price here. We have the red candlestick. This was the open price. The open price was the highest price. Then the price of the stock closed at the lowest price right here. This gave rise to the Marubozu candlestick. Now it is time to look at some patterns. The first pattern is the harami. This pattern occurs over two candles. The body of the first candle completely covers the body of the second candle. A bullish harami is a candlestick indicator suggesting that a bearish trend may be coming to an end. A bearish harami suggests that the bullish trend, uptrend, may be coming to an end. The next pattern is an engulfing pattern. Like the harami, this pattern also occurs over two candles. There can be bullish engulfing patterns and there can be bearish engulfing patterns. This is a bullish engulfing pattern. This is a bearish engulfing pattern. In the bearish engulfing pattern, the bearish candle, which is the red candle, overpowers the bullish candle. In other words, the body of the bearish candle completely covers the body of the bullish candle. So we see here, the open price is higher than the closing price right here. We see here the closing price is lower than the open price right here. So the bearish candle, the body of the bearish candle completely overpowers and completely covers the body of the bullish candle. This is a bullish engulfing candlestick. It occurs over two candles. So this is a bullish candle. The open price of the bullish candle is lower than the closing price of the bearish candle. The closing price of the bullish candle is higher than the open price of the bearish candle. This is a bullish engulfing pattern. Now, I want to mention when it comes to technical analysis, I tend to trade engulfing patterns occasionally. So I will show in a future video how to trade engulfing patterns. The next patterns are the double tops and the double bottoms. So in the double top, the price of the stocks makes two peaks. So the price of the stock went up, it came down, it went up and came down. It made two peaks. This was one peak, this was another peak. This throw here was a neckline. This gave rise to a neckline. Then the price of the asset went up and came down. If this neckline was acting as some area of support, the price of the stocks came down, it broke support, and then went down. This double top price pattern suggests that a reversal is going to occur. And a reversal actually did occur because we see here the price of the stock broke support right here and went down. We also have a double bottom. Price went down, it went back up, it went down, and then went back up. This is a throw, this is a throw, this is a peak. This peak here gave rise to a neckline. The price went down, it went back up. If this neckline was acting as some area of resistance, the price went up, it broke resistance, and then went back up. This is a double bottom reversal pattern. Note, double top and double bottoms chart patterns are very common. You see it all the time. You see it all the time with many different assets. They appear in stocks, they appear in Forex, they appear in commodities, they appear in cryptocurrencies, they appear in all assets that are traded on financial markets. This chart pattern is called the head and shoulders chart pattern. So in the head and shoulders chart pattern, the price of the asset goes up, it goes down, it goes up, makes a higher peak. So this peak here is higher than this peak here. It goes down, touches the area of support. The area of support is the neckline right here. It goes up and then goes down. So what happened is that the price of the asset makes 3 peaks. 1, 2, 3. It goes up, it come down, it goes up, it come down. So this is the first area of support. Price of the asset comes down, it touches support, it goes up, it comes down to support, and then it breaks support. This gives rise to the head and shoulders chart pattern. The middle peak here is the head. The 2 peaks on the side are the shoulders. So the opposite of the head and shoulders pattern is the inverse head and shoulders pattern. So in the inverse head and shoulders pattern, the price of the asset came down, it came back up, it came down, it came back up. So this area now, the neckline is now acting as resistance. The price of the asset came down, it went back up, it touched resistance, and then it break resistance. So in the inverse head and shoulders, there are 3 throws. 1, 2, 3. The middle throw is the head. The 2 throws at the side are the shoulders. This area that was acting as resistance is the neckline. Head and shoulders and inverse head and shoulders are reversal chart patterns. It means that if the price of the asset was going in a particular direction, it suggests that the price of the asset will now change direction and go in the opposite direction. So we see here, if there was an uptrend, and then we see a head and shoulders chart pattern, this suggests that the next direction the price may go is down. So a lot of traders like to trade charts based on price action analysis, and they like to trade based on chart patterns. Basically what they do is that they look for chart patterns, and when they see these chart patterns, they use these chart patterns as a sign about the potential direction the price of the asset may go. In this chart pattern, the head and shoulders chart pattern, it suggests that the next direction the price may go is down. So when the price was going up, we see a head and shoulders, then the next direction for the price to go is for the price to go down. Likewise, we see the price of the asset going down, then we see an inverse head and shoulders. We see 3 throws. The middle throw is deeper than the 2 throws at the side. Then this suggests that the next direction for the price to go is up. So traders can trade based on the head and shoulders pattern, in the sense that if they recognize from beforehand that a head and shoulders pattern is forming, then at this point here, the trader could go short. The trader could sell the asset at this point right here. Likewise, if a trader recognizes an inverse head and shoulder chart patterns, what they could do, they can buy the asset right here. The price went down, it went up, it went down, it went up, it went down, it went up. When they recognize an inverse head and shoulders chart pattern is occurring right here, they can buy asset, they can buy the stock at this point right here, and they can ride the price movement all the way up. The next chart pattern I want to mention is the wedges. So we have trend lines. We see the price of the asset is going up, and we have trend lines. This is a trend line here. The trend line is connecting areas of higher highs. The trend line is marking the potential area of resistance. This is a trend line. We also have a trend line at the bottom here. It's marking the potential area of support. This is a low. This is a low. Well, although this is a green candle, this is also a low. This is a low. So we see a trend line that plot the area of lows. We see a trend line plot the potential area of support. When we plot the 2 trend lines, we plot an upper trend line, we plot a lower trend line. The 2 trend lines are upward sloping. It gives rise to a chart pattern called a wedge. This wedge is called a rising wedge. So 2 upward sloping trend lines give rise to a rising wedge. Note, in a rising wedge, the lower trend line, the trend line at the bottom, is steeper sloped than the top trend line. This suggests that the price might change direction and the price might go down. So a rising wedge suggests that the next direction for the price to go is down. We can also have a falling wedge. We see here a trend line, and a trend line was used to draw resistance. How we know this is resistance? This is a high. This is a high, yes. This is a high, but this is a lower high than this high. So it suggests that the price of the asset is going down. So the market is trending downwards. How we know the market is trending downwards? Because the market is making lower highs. This is a high, but this high is lower than this high. This is a high, but this high is lower than this high. So the market is going down, and we plot the downward movement of the market with a trend line. Likewise, we can plot the downward movement of the market from the downside with a trend line here. So this is a low, this is a low. The market is making lower lows. We plot the lower lows with a trend line. Now we can see here, this upper trend line is steeper than the lower trend line here. This gave rise to a falling wedge. The market is downward sloping. The trend lines are converging. The trend lines are converging. However, the upper trend line is steeper than the lower trend line. This gives rise to a falling wedge. It suggests that the next direction for the price of the asset to go is up. So we also have triangles. Triangles are very similar to wedges in the sense that they show the same triangular type chart pattern. Now, I do not pay too much attention in making a distinction between a triangle and a wedge in the sense that they tend to show the similar type of chart pattern. So here we have a symmetric triangle. We see highs, but lower highs. We see lows, but we see higher lows. So this gives rise to a triangle pattern. We can plot a trend line on top here. We plot a trend line at the bottom here. And when we plot the two trend lines, we get a chart pattern that looks triangular, and it looks very symmetrical. This looks like an isosceles triangle. It looks like a symmetric triangle. We also have an ascending triangle. This was a high, this was a high, this was a high, this was a high. Resistance looks like it's horizontal here. Then we have lows. This was a low, this was a higher low, this was a higher low, this was a higher low. When we plot the lows, we plot the lows. So we use a trend line and we plot the lows, we get support here. We plot resistance with a trend line, we plot support with a trend line. We get a chart pattern that looks like a triangle. This chart pattern is an ascending triangle. The same principle applies here. We plot the lows, we plot the lows here, lows, lows, lows. This gives right. We use a trend line to plot the lows and we get support. Support is horizontal. We plot the highs, we plot the lower highs. This is a high, this is a lower high, this is a lower high, and the price went down here. We plot this with a trend line. We plot the lower highs, so we plot resistance, and this gave rise to this chart pattern, a descending triangle chart pattern. We can do the same thing right here. We use a trend line and we plot resistance. This was a high, this was a high, this was a high, and this was a high. We plot support. This was a low, this was a low, this was a low. We use a trend line to plot support. If we look here, we have one trend line here, and we have another trend line here. This gave rise to a chart pattern known as a rectangle. How we know it's a rectangle? Well, it looks rectangular. If we take a shape here, 1, 2, 3, 4. This gives rise to a rectangular type shape. Hence the reason why we call it a rectangle. Resistance is almost parallel to support. Note, when we draw two trend lines and they are parallel to each other, we sometimes refer to the chart pattern as a channel. So two trend lines that are parallel to each other is sometimes referred to as a channel. So I just changed the color schemes of this chart pattern and this chart pattern. So this is a bull flag. There was a strong movement up. This is a pole. This is supposed to be a green candlestick, suggesting strong movement of the price of the asset in the upward direction. And then the price went sideways. So this is a pole, strong movement up, then sideways. This is a bull flag. The price went sideways. This gives rise to a rectangular chart pattern. How we know this? We have a trend line here. We have a trend line here. The upper trend line plot resistance. The lower trend lines plot support. The price of the asset went sideways and it took a rectangular type shape. So this combination pattern is a bull flag. Likewise, we have a bear flag. There's a pole. There was strong movement of the price of the asset down. Then the price went sideways. It went sideways and in a rectangular type shape. This was resistance. This was support. This is a rectangular type shape. When we combine the pole with the rectangular type shape, we get a bear flag. So a bull flag and a bear flag are combination chart patterns. We also have pennants. If we include a pole, this is a pole here, we combine a pole with a triangle, we get a bullish pennant. Likewise, if we combine a pole, this was a pole down, we combine a pole with a triangle, we will get a bearish pennant. This color scheme is off. This should be a red candlestick rather than a green candlestick because the price of the asset went down. So let me change this color scheme now. So I just changed the color scheme. This candle is now a bearish candle. It suggests that the price of the asset went down. This was the open price. This was the closing price. This was the highest price. This was the lowest price. The price of the asset went down. There was a strong movement down. And then the price went sideways, but it went sideways in a triangular type chart pattern. This gave rise to a bearish pennant. So now that we went through the different chart patterns, the next thing I want to cover are the indicators. Now, there are many indicators. There are thousands of indicators. As a trader, you do not have to use every single indicator that is available on the market. What you need to do is select a few indicators and develop a strategy based on these indicators. In other words, you choose 2 or 3 indicators and develop a strategy to trade stocks based on these 2 or 3 indicators. You do not need to use every single indicator. If you try to develop a strategy and it uses too many indicators, you will get a few entry points because the conditions that you specify that must occur in order for you to take a trade will not occur many times. So you will get a few trades. The indicators I use frequently to trade are the moving average, the Bollinger Band, and the relative strength index. Why I like the moving average? Because the moving average filters out the noise. The noise is a short-term fluctuations in the price, the short-term movements that we can't fully explain. This gives us a noise. So a moving average filters out the noise and it allows us to see the trend. The moving average allows us to see the true direction the price of the asset is moving. So I use the moving average a lot. A moving average is an indicator that smooths out price data by creating a constantly updated price average. For example, an 8-point moving average computes the average of the last 8 data points. So let's assume that we're looking at the daily chart and we computed a 8-point moving average. Basically, what this tells us is that we created a moving average of the last 8 days. So every data point we see on the moving average shows us the average movement of the price over the last 8 days. Likewise, if we created a 100-point moving average, then this shows us the behavior of the price over the last 100 days. This is a moving average here. This is a 10-point moving average. We see the red and the green candlesticks. We see the red and the green candlesticks fluctuating a lot. However, when we apply the 10-point moving average, it filters out a lot of the fluctuations and we get a more smooth movement in the price. This showed us the trend. This showed us the true direction the price of the asset is moving. The price of the asset was moving down. So from here to here, the price of the asset went down. The moving average filtered out after the price fluctuations. The next indicator I use frequently is the Bollinger Bands. Bollinger Bands are 95% confidence intervals around the 20-point moving average. So a confidence interval is a range. It has an upper limit, it has a lower limit. This is a range that is constructed around the 20-point moving average. This middle point here is a 20-point moving average. This is the upper bands, this is the upper Bollinger Bands, this is the lower Bollinger Bands. 95% of the price fluctuation will occur within the Bollinger Bands. 5% of the price fluctuation will occur outside the Bollinger Bands. So this is very important information. If we know for certain that 95% of the price action will be inside the Bollinger Bands, then we know anytime the price of the asset goes outside the Bollinger Band, this is only the 5% chance. So the next thing for the price to do is for the price to go back inside the bands. In other words, the price cannot stay outside the Bollinger Bands. Once the price of the asset goes outside the Bollinger Bands, they must go back in. This is a rule, and this rule holds. This is statistically accurate. This is one of the reasons why I like to trade Bollinger Bands, because once the price of the asset goes outside the Bollinger Bands, they must go back in. So we see here, the price went out the Bollinger Bands here. What the price did afterwards? The price went back inside the Bollinger Band. We see here, the price went outside the Bollinger Band here. What we see afterwards, the price went back inside the Bollinger Bands. Now, based on this information, we can develop a strategy called the Bollinger Bounce. If we know when the price goes outside the Bollinger Bands, it must go back in, then we can say that the price will bounce off the Bollinger Bands. It will bounce like a basketball. It will go out and then come back in. So we see here the price went out and went back in. The price went out, come back, then went back in. So when the price goes out here, if we sold the asset, if we sold the stock when the price went back in, then this would have been a winning trade. And we can see it here, no? The price went out. If we sold, the price went all the way down. When the price went out, if we bought right here, the price went up a little bit. So this would have been a profit, but a small profit. The price went out again. If we bought here, we could have ride the price movement all the way up. So this would have been a very good trade. This is one of the reasons I like to trade Bollinger Bands, because when we get a win, the win could be a very big win. In other words, one winning trade can be so large, it can wipe out about 4, 5, 6, 7. It can wipe out a lot of losses. So this is a very good strategy. If you trade stocks, if you trade Forex, if you trade financial assets based on a Bollinger Bands strategy, you can be a winner in the long term, because the Bollinger Bands are confidence intervals. 95% of the price action will be inside the Bollinger Bands. So when the price goes outside the Bollinger Bands, you know that the price must come back inside the Bollinger Bands. So therefore, what you need to do is trade in the correct direction. Now, if you use Bollinger Bands wrong, in the sense that the price went out here, and then you buy the asset at this point here, then that was madness you're doing. You're not supposed to buy the price here. You're supposed to sell the price here, because the price went all the way down right afterwards. So if you look at the Bollinger Bands, the price went here, and rather than go short, you went long, you bought. So to go long means to buy, to go short means to sell. So if you bought here, if you went long here, rather than going short, then this should be a losing trade. And then you want to blame the Bollinger Bands. You're not supposed to blame the Bollinger Band. You use the tool the wrong way. You're supposed to use the tool the correct way. The Bollinger Bands is an indicator, and it signals reversals. So when the price went down here, it signals that the next direction for the price to go is up. So when you're trading Bollinger Bands, you're supposed to trade reversals, or at least some form of short-term pullback. And we saw it here. We saw the price went down here and then went back up. So you're supposed to trade Bollinger Bands on reversals. Note, I have a strategy for trading stocks based on the Bollinger Bands. I showed that strategy in a previous video. So the last indicator I'll cover in today's lecture is the relative strength index. The relative strength index is a popular indicator as it helps traders evaluate the current strength of the market. It identifies overbought and oversold conditions. In other words, when the price of the asset goes above the number 70, it suggests that the price of the asset is overbought, so it has become too high, and the next direction for the price to go is down. Likewise, if the RSI falls below the number 30, it suggests that the price of the asset has become oversold. In other words, the price of the asset has become too low, and the next direction for the price of the asset to go is up. I have a strategy for trading financial assets that rely on Bollinger Bands, moving averages, and the relative strength index. So when I apply these three indicators together, I wait for a Bollinger bounce, meaning that I wait for the asset to go outside the Bollinger Bands, then go back inside the Bollinger Bands. Now, I have a directional bias. I prefer to go long when trading stocks. So when trading stocks and when I'm using Bollinger Bands to trade stocks, I want the price of the asset to go down, go outside the Bollinger Band, then go back inside. So that's my first criteria when trading stocks based on technical analysis. I want the price of the asset to go outside the Bollinger Band from the downside and then go back inside. So I want a Bollinger bounce. Let me show you. So I want a Bollinger bounce. I want the price of the asset to go out, come out here, and then go back inside. The second criteria I want is a price crossover. I want the price to cross the moving average. So I want the price to cross either a 9-point or a 10-point moving average. The third thing I look for is the relative strength index. I want the relative strength index to go into oversold conditions. If the relative strength index goes to the number 30 or below the number 30, it suggests that the price of the asset has become oversold and the price is too low. So the next direction for the price to go is up. So once all three indicators tell me the same thing, I tend to go long, I tend to buy. So the first criteria, one, I want the price to go outside the Bollinger Band, then go inside the Bollinger Band. Two, I want the RSI to drop below the number 30. And three, I wait for a price crossover to occur. Note, this strategy works. This strategy might not give you many trades, but the trades it gives you will be winning trades. You can take a few trades, the few trades can be winning trades, and when you take these wins, these are very big wins. This strategy works when you're day trading. This strategy works when you are scalping. This strategy works even when you are swing trading or position trading. If you plan to invest, I would use this strategy in conjunction with fundamental analysis. In other words, I do not invest in any asset by looking purely at technical analysis factors. I do not invest in any stock based solely on charts and indicators. When I invest in stocks, I combine both technical analysis and fundamental analysis. My previous video showed you how to apply fundamental analysis while trading stocks. You could use those same strategies to trade stocks. You could use those same strategies to position trade. Position trade is when you hold for several weeks. You could use the same strategy if you are day trading. Day trading is when you open and close trades within one day. You could use those same strategies for investing. Investing is when you hold the asset for more than a year and you plan to make a profit from the dividends paid by the asset over a period of time. You could use those same strategies when you are investing. So we covered a lot of content in this lecture here today. This brings me to the end of this lecture. This is Dr. Don Charles, and thank you for listening. Stay tuned for more.